This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 6 videos on trading the open. Many traders think of the day as having 3 parts. They're particularly interested in trading the open the first hour or two because that is usually the easiest time to make money. Also, starting around 11:30 or so, 11 o'clock, the final hour or two is another great opportunity to make money as well. The market often has a trend up or down into the end of the day. The middle session of the day often is sideways and in a trading range, and traders tend to be more cautious. Because the open of the day is the single best time of the day to find swing trades, I want to talk about opening reversals. These are setups on the open that often lead to swing trades. For example, we clearly have a swing on the open here and a swing at the end of the day here. We have a swing up here, early trading range here. The middle of this day was a bear channel. Here we have a swing on the open and a swing up at the close, and most of the day, the middle of the day, was a trading range. And sometimes the middle of the day is only an hour or two. Usually it's more like 2 or 3 hours. A lot of times the market will go one way, and then the other way, and then back the first way. So here we have a bear trend, trading range, trend resumption. Here we have a bull trend, a bear trend, and then trend resumption up. Most days are not that obvious, or at least not that obvious when you're trading them. They become obvious when you print the chart out at the end of the day, but when you're trading it real time, sometimes it's very difficult to understand what's going on. A lot of traders focus on trading in the open of the day, the first hour or two, and the end of the day. And what that leaves is the middle of the day, which is less clearly defined and less often has big swings. Easier to make money in the first or last hour or two every day, because it's the most common time to have breakouts with follow-through, in other words, swing trades. I don't think volume is particularly important. It used to be 20 years ago, 30 years ago, when the E-mini first started, 18 years ago, in the early years of the E-mini. But nowadays, at times when you see very small volume, it's irrelevant. Volume is not an indicator of whether or not the market has the ability to trend. I've seen days where the market goes hours in a very tight trading range with very little volume and then breaks out and goes a long way. And sometimes the breakout has big volume. Other times the breakout has very little volume. I don't care what the volume is. I just care about whether or not the market is breaking out. If I see this, I don't care what the volume is. I'm selling. If I see this, I don't care what the volume is. I'm buying. Because the volume is greater in the beginning of the day, and especially right before 1 o'clock Pacific time, those 10 minutes before 1 o'clock, the volume is very, very big. It means traders and institutions are trading more intensely. I guess it slightly increases the chances that you'll get a sustained move up or down, but I never look at the volume to decide whether or not it's good enough to trade. I just look at the trends. If there are trends, I'm looking to trade. Traders like this, they like that. A lot of times they don't trade when it's like this. Traders become much more interested when the market is moving, and it's more likely to move in the first hour or two and the final hour or two. In the middle of the day, a lot of times the transitions are not all that clear, and a lot of times the market goes sideways in a series of two-legged moves, and a lot of them subdivide. So leg 1, pullback 2, leg 2 subdivided into 1, pullback 2, leg 1, pullback, and then 2, leg 2 subdivided, 1, pullback 2. Transitions often not clear, lots of reversals, lots of sideways price action, overlapping bars, a lot of prominent tails. A lot of traders trade less in the middle of the day. They prefer trading when the market is having good swings, and good swings are more common early and late. Because the day often has 3 parts, there are often 2 or more transitions, and traders like to trade the transitions because they like to be selling as early as possible on a swing down, more profit potential, and they like to be buying on a swing up, more profit potential. If you're looking for 3 parts to the day and the day is not clearly unfolding in 3 parts, does not matter. You trade what's in front of you. A strong trend day often begins right on the open. Not necessarily. Sometimes it'll begin after an hour or two. But a strong trend day typically early on begins trading in one direction without ever trading much in the opposite direction. Here's a strong bull trend, and here's a strong bear trend. Both are right from the open. Therefore, traders want to sell early here and swing if possible, and buy early here and swing if possible. How often do you see days that look like this or that? Not often, maybe 2 or 3 days a month. So about 10% of the time, you get very, very strong trend days. Most days are not strongly trending one way or the other. A lot of times you'll get a strong trend for the first couple of hours, and then the market goes mostly sideways for the rest of the day. Most days, 90% of the days, the price action will change. Instead of staying in a strong trend up or down, it'll either enter a trading range or it'll begin to trade in the opposite direction. It'll have a reversal. We traded down, we traded up, we traded sideways. There are only 3 things that the market can do. Break out and form a bear trend or a bull trend. It can channel. We have a channel up here. Or it can be in a trading range. And we have a bear breakout that failed. We have a bull breakout with the second leg up. It became a bull channel. So you either have a breakout down or up, or a channel down or up, or a trading range. Those are the only 3 things that the market can do. And you trade each of them differently. 90% of the days do not trend relentlessly one way or the other. That means 90% of the days have at least 2 types of price action, either a breakout, a channel, or a trading range. Traders are constantly looking for a transition from one type to the other. When the market changes from a breakout to a channel, or from a channel to a trading range, or from a trading range to a breakout, traders have to change how they're trading, because that's how they maximize their profit potential. They have to trade what the market is currently doing, not what it was doing a few bars ago. I mentioned that most days do not clearly have 3 parts to the day. A lot of times when you print them out at the end of the day, you'll see the 3 parts. But this is how traders think. They look for a trade on the open, they look for a trade at the end of the day, and then they trade the middle of the day, however it appears to be. A trading range, they'll trade it like a trading range. A trend, they'll trade it like a trend. Most days are not strong trends. Most change their character, and they have some combination of breakout, channel, and trading range. When there are 3 parts to the day, they do not divide evenly. 81 bars in the day, it's not as if a third of them, 27 of them, are the first part, and 27 more of the middle part, and 27 more of the third part. Sometimes one or more of the 3 parts can be very small. Sometimes one or more can be very big. For example, here, the middle third of the day is not the middle third in terms of the number of bars. We're in a trading range, and then it transitioned into a bear channel, and then a bull breakout, mostly a breakout, a very tight bull channel. And the second of the 3 types of trading lasted a lot longer than the first or third. I'm always paying attention to whether or not I think the market's in a breakout, a channel, or a trading range, because I trade the 3 of them differently, and it's good to recognize each of the 3 as early as possible. Some days have only one type of trading. If there's only going to be one type, it's most commonly a trading range. You'll virtually never see a breakout that lasts all day. It'll usually transition at least into a tight channel. Channels can last all day, broad channels or tight channels, but trading range days commonly last all day. Some days have lots of transitions. Instead of just 3 parts, they can have 5 parts, 6 parts. For example, trading range, tight channel, bull channel, bear channel here, bull channel here, breakout here. You simply trade what's in front of you. It's very often that the past few bars look one way, like a breakout, and once you see more bars, you discover that they're part of something bigger, like a trading range or a channel. We have a very tight bear channel, but it became a leg in a trading range. We have a very tight trading range within a bigger trading range and within a broad bear channel. Strong bear breakout, very deep pullback, it's a trading range, and it's a broad bear channel. Is the open just the first bar? Is it the first hour? Is it the first 2 hours? It differs on every day. You're looking for the time before there is a swing. That is the opening range. And some days there is no opening range. It just simply rallies on the open. You could call this whole thing the opening range, but I would call this more a trend from the open bull trend. To me, this is not an opening range type day. It's a trend from the open bull trend and a parabolic wedge that reversed and formed an early high of the day. Here, the opening range may have been right here. Maybe you'll say it's the first 10 or 15 bars right here. Here, a limit order open, a trading range open for a couple of hours. The bulls bought the reversal up. They sold the reversal down. Here, on the open, the market simply went sideways for several hours. Traders looked to trade reversals, buying failed breakouts below the bottom, buying higher lows, selling double tops and reversals down. Here we have a gap up and a double bottom, this low and this low. The bulls got a small rally, but it did not last long. But to me, this would be the opening range on this day. Is the opening range just this first cluster of bars, or is it all the way down here? I would call this the opening range and this a swing down from the opening range, but it does not matter. Same with all of these. No opening range, small opening range. Here's the first trade of the day. Once the first swing up or down ends, then traders conclude that that first third of the day has ended. Here we have an opening range, a trading range, and it continued all day. This is the opening range, and then the day became a trading range day. On a day like this, you're not really clear when the open actually ended. Did it end here? Did it end here? I don't think it matters because the market's in an early trading range and it continued in a trading range, and traders would keep trading it as if it's in a trading range until there's a clear and strong breakout one way or the other. Most days have at least a small early trading range before there's a swing up or down. This is unusual. Maybe 20% of the days, the first bar is the low or high of the day, a trend from the open bull trend. Next, I want to talk about opening reversals. In the first hour or two, sometimes in the very first minute of the day, the market begins a swing trade. And there are setups that often tell traders that a swing trade is about to begin. This is a very important slide. It's a problem for traders starting out. They'll see a very strong breakout like this and they'll conclude that the day has to be a bear trend. Or they'll see a very strong rally on the open and they'll conclude that the day is probably going to be a bull trend. And that is wrong. On the open, no matter how strong a sell-off, no matter how strong a rally, 50% chance it's going to fail and reverse. And that takes a while to get used to, but that is the truth. 50% of strong moves on the open reverse. So don't get fooled. If you see a strong sell-off like this and then you get a bull bar closing over its midpoint or on its high, it's often an inside bar or a big reversal bar. If you're short, it's better to get out of shorts. If you want, you can often get long. And the opposite's true here. If you see a strong rally on the open within a few bars, you get a bear bar closing on or near its low, it's reasonable to get out of your long. And then if you get another buy setup, you can buy again. Here a high 2 bull flag, high 1, high 2. Some traders will short, taking a chance that it will remain the high of the day. So they'll sell below that bear bar, put a stop above, and then just wait. And you can see the market tried to go up. It could not run the stops of the bears, and it reversed down. Opening up, and then a reversal down. Opening, reversal. Strong sell-off, and the market's always in short, yet it reversed up. It's an opening reversal up. I would call this an opening reversal up from the 60-minute moving average. Even though it fell several points below the 60-minute moving average, a lot of times that's what happens when you get a test of the 60-minute moving average. Sometimes the market will fall 5 or even 10 points below and then reverse up strongly. If you want, you can also call this a second failed breakout below yesterday's low. We don't see yesterday's low, but this is a gap down below yesterday's low. We try to reverse up. An even stronger breakout below yesterday's low, and it reversed up. This is an opening reversal up, and this is a second opening reversal up. This is an opening reversal down, a reasonably strong rally to resistance, the moving average and a bear trend, and about a 50% pullback from yesterday's close to today's opening low. Opening reversal up, and it became the low of the day. Strong rally on the open, above the moving average. However, it became the high of the day. Bear bar right after the rally. It went sideways for a lot of bars, and the bulls tried to resume, but it remained the high of the day, and the reversal took place here. Big up, big down, not quite as big as the up, but big enough down to make traders think that this might be a double top. We might break below the neckline and fall for at least a measured move. Opening reversal down. Opening reversal, it's an early reversal at support or resistance. If you get a strong sell-off down to support and the market reverses up, it often is the low of the day, like this, and this. If you get a strong rally on the open and it reverses down, that reversal down is an opening reversal down. The opening reversal often is some other pattern as well, like a wedge rally here, micro double top here. Sometimes it's a final flag or a lower low major trend reversal. Here, a double bottom, slightly lower low double bottom from yesterday. Here we have a double bottom bull flag. The market's rallying. We rally, we pull back sharply. The bears try to get a reversal. Instead, the bulls get a double bottom at the moving average, and the market reverses up. You can see the moving average. We gapped down from yesterday's close, maybe below yesterday's low, and we reversed up strongly again and again, a third time. Yet the market reversed down at the moving average. 3 reversals up, each failed. It's a wedge bear flag. Bear flag because we're below the moving average and below yesterday's close. And then it became a double top as well. But at this point, it's an opening reversal down, possible high of the day. Bears will sell and put a stop above the top of the wedge. This tested the stop but never hit it. We broke strongly above yesterday's high and stalled. We got a micro double top and a reversal down, an opening reversal down from the resistance at yesterday's high. This is last week's low, and this is a strong sell-off trying to break below last week's low. Last week was a sell signal bar, and the bears were hoping to get a weekly sell signal. Instead, we had a very strong sell-off and then a very good bull bar closing on its high. The bulls were buying, betting that the market would not trigger the weekly sell signal, and the bears were buying back their shorts once they saw this good-looking bull bar. We broke strongly below yesterday's low, yet we reversed up, an opening reversal up from below yesterday's low. The market's in a bull trend, and we tried to rally on the open, and then we reversed down strongly. The bears were hoping this would be the high of the day. Instead, we reversed up strongly, and this is a double bottom at the moving average in a bull trend. So a double bottom bull flag, opening reversal up after a sell-off down to the moving average. When the market has an opening reversal, the size of the initial wrong move is significant. It determines what will happen next. For example, here we have a sell-off that is about 25 to 50% of the size of the prior day's range. I don't see the full size of the prior day's range, but it's not a particularly big sell-off. And when you get a reversal from a sell-off that is not particularly big, the day often can go and become a very big bull trend. So a sell-off, reversal above the high, and you can get a very big bull trend out of it. And you can see it went up for about a measured move up based upon the initial sell-off, maybe a little bit more. The rally after the reversal went far above the open. Now that's very different from an initial sell-off that is between 50 and 100% of an average day's range. This sell-off is about the size of an average day's range, even though the sell-off was only in 4 bars. Whenever the initial sell-off is big, and then you get a reversal, it doesn't matter if it's a reversal on the open or if the reversal occurs later in the day. The reversal usually leads to a trading range rather than a big bull trend. Sometimes the market gets above the high, as it did here, but when it does, it usually does not get much above the high. A lot of times it'll get near the high, not quite above it, and then simply go sideways. A big initial sell-off, if you get a reversal, usually results in a doji bar on the daily chart, a down move and an up move, but not a big trend above the high. It can rally all day. Here it rallied for about 70 bars, but only barely got above the open. It simply retraced the 4-bar sell-off. It took 70 bars to retrace those 4 bars, but that's all it did, was retrace the 4 bars. Initial sell-off, very big, about the size of an average day's range in just 4 bars. When you get a reversal, the reversal usually has a hard time going much above the high, if it does go above the high at all. This is true for all reversals. These charts are examples of opening reversals, an early sell-off and a reversal up, early sell-off and a reversal up. But it would not matter if the sell-off lasted until the middle of the day and then you got the reversal in the middle of the day. The same thing. If the sell-off is very big, the reversal often will retrace the entire sell-off but not go for a measured move up. It usually has a hard time going much above the top of the bear leg. That was a bull reversal, and now I have bear reversals illustrating the same point. Here, the rally is very small, probably less than 25% of an average day's range. Once you get a reversal, the reversal can lead to a very big trend day. Very small rally, maybe 25% of an average day's range. When you get a reversal, the reversal can be much bigger than that initial rally. And here, it's many times bigger, not simply a measured move down. It's maybe 3, 4, 5 times the height of the initial rally. This is a very big rally on the open, about the size of an average day's range, and it occurred simply in the first 15, 20 bars or so. Whenever you have a very big rally on the open and you get a reversal, usually the market has a hard time falling much below the low of the day. Rarely, I say rarely, maybe 20% of the time, it goes very far down and falls for a measured move or more, and that was the case here. A very big rally, and then we get a reversal. Usually the reversal will have a hard time falling much below the low of the rally. Sometimes, maybe 1 chance out of 5, it'll fall for a lot further and go down for about a measured move, as it did here. And this is true whether or not the reversal occurs on the open or whether it occurs later in the day. This is on the open. This is a little bit later in the day, but it would not matter. If the reversal topped out here and came down, the same logic holds. If the initial rally is very big, the sell-off, it can last for the remainder of the day, but usually does not go far below the bottom of the bull trend. This is the exception where it does go very far below the bull trend. At any given bar on the day, what's the chance that you've already seen the high or low of the day? This is the E-mini chart. It has 81 bars in the day session on a 5-minute chart. At the close of the first bar, there's a 20% chance that the first bar will remain the low of the day, and a 20% chance that it is the high of the day. At this point, by the time the bar closes, you don't know which it'll be, but there's a 20% chance it'll be the low and will go up, or the high and will go down. By the end of the 7th bar, there's a 50% chance that the market has either already made the high or already has made the low. By the end of the 12th bar, the end of the first hour, there's a 70% chance that either this will remain the low or this will remain the high. Bar 18, hour and a half into the day. You can test this yourself, what I'm about to say, but it's true. By the close of bar 18, there's a 90% chance we've seen either the low or the high of the day. There's nothing magical about 18. I could have picked bar 15. And by bar 15, instead of 90%, maybe there's a 80%. I could have picked bar 30. And by 30, maybe 95% chance that we've seen the high or low of the day. I use bar 18, and it's a pretty reliable marker for the high or low of the day, 90% chance. And that's important because if you break below the low, then you know the market's not going above the high, 90% certain, and therefore the day is either a bear trend or a trading range day. If, on the other hand, it breaks above the high of the 18-bar range, the first 18 bars, then the day is probably going to be a bull trend day or a trading range day, and it's probably not going down to a new low. Here's bar 80. The 5-minute chart has 81 bars. What's the chance that by the close of bar 80, we've seen the high or low of the day? 99.9% chance by the close of this bar, either this will remain the high or this will remain the low. Is that useful information? Of course not, because you're not going to be placing a trade based on that information for the last bar of the day. Traders are always looking for a swing trade early in the day. Early in the day, there's a 90% chance that you're going to have a profitable swing trade up or down. By the close of the first bar, you have a 20% chance that you've already seen the high or low of the day, or at least the high or low of the next several hours. First bar of the day here, even though we sold off for 5 hours, it remained the low of the day for the first 6 hours. First bar here, despite this reversal up, it remained the high of the day for the remainder of the day. First bar here, a bear reversal bar, it remained the high for the next 40 bars. This video, I'm going to focus on finding a swing trade on the open. By the open, I don't necessarily mean the first bar, I mean the opening range. Sometimes there is no opening range. Sometimes the market just rallies immediately from the first bar. More often, it goes sideways for an hour or two. That hour or two is the open. Traders will look for a swing trade during that opening range. I'm going to be talking about swing trading here. If you want to find out information about scalping, you can look at the videos on scalping. There's often a report that comes out at 7 o'clock Pacific time, and that's bar 7. By the close of that 7th bar of the day, there's a 50% chance we've seen either the high or low of the day, or it's certainly the high or low for the next several hours. Bar 7, it became the high of the day. The first 90 minutes, there's a 90% chance that the high or low of the day has already formed. I'll talk more about this in a later video on trading the open. Here's the high of the day, high of the day, high of the day. This is by the 18th bar, all of these. When I talk about swing trading in the E-mini, typically I'm talking about a profit of 4 points or more. There's a 90% chance of a swing trade, a 4-point profit, beginning in the first 2 hours. We have a swing up, a couple swings down here, several swings down, all beginning within the first couple of hours. There's an 80% chance of a swing trade beginning in the last 2 hours as well. Everyone should be looking for swing trades of 4 points or more. It's the easiest way to get consistently profitable. There's a 50% chance that you'll get a swing trade beginning in the middle of the day. So here we had a quiet trading range day, and the second half of the day became a trading range. It's very common to find swing trades in the middle of the day that began in the first 2 hours. Middle of the day, we have a swing trade that began in the first 2 hours. Because the market is either going to have a swing trade starting in the first 2 hours or shortly afterwards. Traders should work very hard to look for swing trade setups in the first 2 hours and in the last couple of hours of the day as well. You can see in this sample of charts, there were swing trades that went into the end of the day on every chart. I've had friends who only traded the first hour or two. I had one friend who only would trade the first hour every day. He was trading 100 T-bond futures contracts. He told me, Al, I looked at my results and 85% of my profits came from the first hour. Therefore, I'm only going to trade the first hour. Other traders trade only the beginning of the day and the end of the day, with very little trading in the middle of the day, because the middle of the day often is quiet. I had another friend who used to trade the first 2 hours and then go out on errands for the middle 2 hours and then come back and trade the final 2 hours. He was a very successful and consistently profitable trader. In fact, he and I traded together for years. To be honest, I don't remember a day when he lost money. Trading range is more likely going to consolidate the move of the first hour. It often has tight trading ranges and lots of minor reversals. Traders often end up entering with limit orders during that middle third of the day. Beginners should not be entering with limit orders, and therefore, when the middle of the day looks like this or like this, usually most traders should not be trading like that, like this. Traders tend to think of the day as having 3 parts. They pay particular attention to what takes place in the first couple of hours because that is the time of the day when they have the best opportunity for a swing trade. Also, they focus again intensely in the final hour or two because there's often a swing trade at the end of the day. The middle of the day often has swing trades as well, but traders tend to be more cautious and the market is more likely to be in a trading range. Because the open is so important, there are a number of setups that take place, especially opening reversals, and I discussed several of them today. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 6 videos on trading the open. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 6 videos on trading the open. Why trade the open? Because it has a high probability of having a swing trade where a trader can make at least 4 points. I want to talk a little bit about some common patterns that traders should look for on the open. For all traders, stop orders in general are better than limit and market orders. For beginners, traders should only trade with stop orders. I want to talk a little bit about the most important rule in trading, and that is that traders have to be prepared for anything. Everybody should be looking for swing trades, and they're usually easiest to find in the open because there's a high chance of a swing trade occurring sometime in the first hour or two. We have a pair of bull bars, each closing on their highs after a gap down. Here's the average price. Traders will buy the close of that second bull bar, betting that it might be the beginning of a swing up. Parabolic wedge top, traders will sell, hoping for a swing down. We have a double top, both with good sell signal bars. And now we have consecutive bear bars closing on their lows. A second entry sell below that bar. Traders will either sell below that bar, or they'll sell a close, or they'll sell below a pullback. This bull bar is a pullback from these consecutive bear bars. We have a double bottom. We have a minor reversal and now a double bottom. Traders will buy back their shorts. Aggressive bulls might buy, looking for at least a trade up. The market rallied strongly, sold off strongly, and now has a good bull bar closing on its high. The bulls are hoping for a double bottom. They'll buy above that bull bar for a swing up. Remember, a strong move on the open, 50% chance it's going to reverse. And if you get a good reversal bar like this, a bull inside bar closing on its high, it's a reliable buy for a trade up. Now we have a double top here and here below the moving average, and a micro double top with a bear bar closing on its low. The bulls who bought will get out below that bear bar if they did not already take profits up near the moving average. Reversal down, reversal down, reversal down. Trading range, high or low, lower high here. Decent sell signal bar here at the moving average. Reasonable sell, looking for a swing down. Big gap up above the moving average, 2 legs down, 1 pullback 2. It's subdivided into a wedge. We rallied, we bounced, and we're trying to bounce above the moving average with a good bull bar, a reasonable buy for a possible low of the day. It was the low for the next several hours, but not the low of the day. A pair of bear bars reversing down at the high of the day. Reasonable to exit longs at that point. We're below the moving average, probably gap down, and now we have a double top, slightly higher high double top below the moving average with a bear bar closing on its low, a reasonable short for a possible swing down. Later in the day, we got a wedge bottom, reversed up, reversed up, reversed up. It's nested. There's a smaller wedge here, up, up, up. Reasonable to get out of shorts, and bulls will look to buy for a reversal up. I think the next few charts are important. I want you to pay pretty close attention to them. We sold off and rallied. It created a tail on the bottom of the bar. We rallied a little bit on the open and sold off, created a tail on the top of the bar. This is a 5-minute chart, and this is a daily chart. %90 of the time, if you have a bull day on the daily chart, this tail is caused by an early sell-off and a reversal up. And the top tail is usually caused by some late profit taking, end of the day. Here's the open of the day, low of the day, and this tail on the bottom of the bull day was caused by this early sell-off. There's the close. This tail on top was caused by this late sell-off. Only 10% of the time when you have a bull day like this is the tail caused by a late sell-off. Here's the open of the day, and here's the low of the day. It occurred late in the day, and that's only 10% of the time. 90% of the time during a bull trend day on the daily chart, you'll have an early sell-off and an early reversal up. Trading range day, here's the open, there's the low, here's the open, here's the high. Big tail on the bottom, here's the high, here's the close. That's the top of this white box. When you look at this bar on the daily chart, you don't know that the bottom tail was formed early in the day and the top tail came after the bottom tail. But you know that one of the tails was probably formed early in the day. You can say, well, Al, it's a bull body. Doesn't that mean that the day sold off and then rallied? No, not at all. In fact, that's not what happened here. We sold off, rallied, and then sold off again. Here's a bear day. 90% of the time, that tail is caused by a small rally early in the day that reversed down. And 90% of the day, bear day here, that little tail on the bottom is caused by a little reversal up at the end of the day. We reversed up and sold off, but closed above the open. %10 of the time, when you have a bear day like this, that tail on top, instead of coming early, comes later in the day. We had a high late in the day, late in the session, and then a reversal down late in the day, and that big tail came late in the day. I want to talk a little bit about very common patterns that traders see on the open. The 3 most common patterns, here we have a trend from the open bull trend. Begin with the very first bar. Sometimes it begins with the second or third bar. We have a gap up here, and on the third bar, we began a trend from the open bear trend. It's also a double top, lower high, major trend reversal. Bull trend, bear breakout, and a lower high major trend reversal. That's also a double top bear flag. Now, you can get a trend from the open. Here we got it up, here we got it down. You can also have a breakout mode open, in other words, an early trading range, and then a breakout. A standard breakout mode pattern means there's a new low of the day that reverses up, a new high of the day that reverses down. Theoretically, traders will buy a breakout above the top and sell a breakout below the bottom. Here we got a breakout above the top, and the market continued up for the rest of the day. This pullback never fell below the low of the day. Higher low major trend reversal. That's assuming there was a bear trend before this. If not, you can simply call it a deep pullback from this bull breakout above the early trading range. Breakout mode, after the first bar, there's a reversal down and a reversal up. Usually for breakout mode, I want the pattern to last at least 10 bars. So for me, it would be a reversal up and then a reversal down here. And traders would sell below the low or buy above the high. You can also call this a double top. Whenever there's a trading range, there's always going to be a double top and a double bottom. The third type of pattern is an opening reversal. You can get a trend from the open, up or down. You can get an early trading range with a breakout up or down, or you can get an opening reversal, where the market goes one way and then reverses and goes the other way. We have a gap up above the moving average, and then a pullback to the moving average. The bears were hoping for a trend from the open bear trend like this. Instead, we reversed up on the open an hour into the day, maybe a little bit more, and this is an opening reversal, a wedge bull flag. It led for a little swing up for the next several hours. Here's the moving average. We gap down below the moving average, and we got a double top bear flag, an opening reversal down from below the moving average. Here, an opening reversal up. Here, an opening reversal down. You can call it a low 2, you can call it a small double top. Here's the moving average. We gap down. This is a high 1 buy, a failed breakout below the moving average. We don't see what yesterday looked like, but this might also be a reversal up from below yesterday's low. This is hard to see. The second bar traded below the first bar. That's a low 1. And then the fourth bar traded below the third bar, and that's a low 2, a micro double top and a low 2, and then a bear trend. I'm mentioning this because some traders like to count bars and count reversals and count pullbacks. Micro double top, the market went up and down on the first bar, up on the second bar, and down on the third bar. Micro double bottom, we went above the first bar, we sold off, and then we went above the third bar. So small double bottom with the low of the first bar and the low of the third bar. A lot of traders will buy that as a second entry buy. Another double bottom here and another double bottom here. Traders will look to buy reversals up from a double bottom. We don't know what the bars to the left look like here, but if it was a bear trend, this would be a double bottom, higher low, major trend reversal, and a reasonable buy for a swing up. If you want, you can also call it a triangle. We have a higher low here compared to this. We have a slightly lower high here, maybe a double top. Doesn't matter what you call it. It's a three-legged move, a very tight range. It's breakout mode, whether you call it a triangle or simply a tight trading range. Below the moving average, we have a double top below the moving average. So low 1, low 2, micro double top. You can call this low 1 and below there, low 2. Every double top is a low 2. And this one, the second high, subdivided into a smaller low 1, low 2. A third little reversal down, if you want, you can call it a triangle. Every low 3 you can think of as a triangle or a wedge. A bigger triangle, lower high, higher low, does not matter that this high is above that high. It's still basically a triangle, breakout mode. First reversal up, high 1, second one, high 2, third one, high 3. All three failed, so a failed wedge bottom. The breakout below the wedge bottom failed, and the market reversed up. That happens 50% of the time. If you have a wedge bottom and a bear breakout, 50% of the time, the bear breakout will fail. If a trader was long, looking for an early low of the day, he would exit probably below the low of the wedge and then consider buying again if the bear breakout failed. Wedge rally, 1, pullback 2, pullback 3. So a low 3 short. In a bear trend, we're below the moving average. Reasonable short. I want to say a few things about stop and limit orders here. I talk more about it in the videos on scalping. We have trading ranges here and here, but they're different. This one is broad, has micro channels, a series of bars here, 4 bars without a pullback, and then another series of 6 bars here without a pullback, and then here we have 4 bars down without a pullback. A lot of the bodies are big, not much overlap between the bars. When a market looks like this, you can trade with both stops and limit orders. Traders like to buy low with stops, betting on a swing up. They'll also buy with limit orders. For example, when a bar is closing strong, they'll buy just before the bar closes or just after the bar closes and get filled on the next bar. If they see a sell-off down to a support, like a prior low, and then there's a bad sell signal bar, like a bar with a bull body or a doji, chances are there'll be buyers below the bar, so they'll place a limit order to buy at that low and get filled on the next bar. Same here, 3 consecutive bull bars closing at or near their highs. Chances are a reversal down will fail, and the bulls will get at least one more leg up. They'll place a limit order to buy at the low of the bar, betting against a reversal down, and betting that the bears will get trapped and will get at least one more leg up. Opposite is true for the bears. A second entry short, first below this, second below that. We have 2 legs up, 1 pullback 2, a big bar, possibly a climactic end of the move. They'll sell on the reversal down. Here we have a double top bear flag. Even with the bull bar, they'll sell, looking for a second leg down after a buy climax. 1, pullback 2, and the first leg down subdivided. Here, a low 2 bear flag, low 1, low 2, bear bar at the moving average. They'll sell with a stop order, betting that this is now a bear swing, maybe a bear trend. Limit orders, strong reversal, they'll sell the close, looking for at least a little bit more down. 3 consecutive bear bars after a buy climax. They expect at least a small second leg down, maybe a big second leg down. They'll sell above a bull reversal here. Here we have a high 2 buy, but a tight channel, only 1 bull bar in the past 7 bars, and a bear body here. They'll sell with a limit order there. Strong bear breakout, follow through. They'll sell closes of the strong bear breakout or the follow through bar. And then here we have a good sell signal bar for a low 2, and then a good reversal bar, reversing this rally, closing on its low. They'll look for maybe a breakout and a measured move down. They will sell the close. When you're selling the close, selling at the market, it's the same as selling with a limit order. Some traders simply hit sell the market. Other traders will place a limit order as the market is closing to sell at a certain price where they think the close will be, or they'll place a limit order as soon as the bar closes to sell at the close of this bar, and then they get filled on the open of this bar if this bar trades above that close, which is where their limit order is. Compare this with what you see here. Here, tails are prominent, reversals are coming every 1 or 2 or 3 bars, and there is a lot of overlap. The market spends a lot of time in small, tight trading ranges, and the entire chart is in a tight trading range. If you're an extreme scalper, which very few people are, you're capable of making very quick decisions. You can enter with limit orders, buying below bars here, buying below bars here, scaling in using wide stops and scalping, and doing the opposite above bars. You sell above bars, you sell more higher, you sell above bad bull flags, betting on reversals instead of on breakouts. In other words, you're betting that every attempt to become a trend will fail and the trading range will continue. You sell at prior highs. You sell above bad-looking buy setups. Buying above a bear bar like that after a tight trading range like this, probably sellers above. Here we have a pair of bear bars. You'll sell more higher. You'll buy with limit orders. You'll buy below bars, big bar with a tail. You'll buy strong bear closes in the bottom half of the developing range, betting that you'll get a reversal instead of the start of a bear trend. You'll buy new lows. You'll scale in lower. The bulls, they will scale in higher. The bears who are selling, if they sell here and it does not go down immediately, they'll sell more higher. When the market has trending type behavior like this, you can patiently wait for a pattern and for a good signal bar before entering with a stop. We have a micro double bottom, down, down again at a prior low. Probable trading range, big up, big down, means big confusion, usually means the trading range. Therefore, traders will look to buy low, sell high, and take quick profits, scalp. If a leg down is strong, a lot of traders will wait for a micro double bottom or a second entry buy, especially above a good buy signal bar. And the opposite is true at the top. Traders will look to sell on a reversal down from a prior high, especially after two legs up, one pullback two, and especially if there is a buy climax, an unusually big bull bar. For example, this is the biggest bull bar in about 20 bars. About 10% of the days look like this all day. So a couple of days a month, the market's in a tight trading range all day, and there are very few good stop entry buys or sells. Stop entry traders simply wait for the rare opportunity to sell with a stop on a reversal down from the top or on a reversal up from the bottom. Here, there's no great looking stop entry buy. And they also wait to see if there's a strong breakout. Maybe the tight trading range will become a strong trend, and then they can start trading with stop entries again. For example, buying pullbacks if there's a strong bull breakout and selling pullbacks from a strong bear breakout. When there are no good stop entries, traders will often buy on the close of consecutive bull bars, betting that the market will have at least a small second leg up. And that's true here as well. Two big bull bars closing on their highs, not much overlap. Two big bull bars closing on their highs, not much overlap. Odds are the bulls will get at least a small second leg up. If they take the buy and they're disappointed by the follow through, here a doji and then another doji, another doji, they'll be getting out. Most of the bulls were getting out here or here, and the ones who did not gave up here. This is a pair of give up bars, and it represents the bulls giving up. Here we have a pair of consecutive bear bars. This bar, breaking below the low of the range, has a fairly prominent tail. Not good for the bears. Closed below the range, which is good. But look at the next bar. There's no follow through. The market immediately reverses. Much more common in a trading range than in a trend. Some bulls will buy the close of the bear breakout bar, betting on a continuation of the tight trading range instead of the start of a bear trend. Here's the average price. This is a big gap down from yesterday's close, and the market's reversing up on the second bar. Bull bar closing on its high. A lot of bulls will buy on a stop just above that high and get filled here above the high of that bar. Now we have a strong rally, but it's stalling right below the moving average, and we have a second reversal down. Traders will recognize this as a potential opening reversal and possible high of the day. Because this rally is strong, many traders will not take the first entry. However, they will take the second entry below this bar and get filled here. Now we have a double bottom. This low is slightly below that low. We broke below yesterday's low, and we're getting a double bottom reversal up. And then we have a micro double bottom as well, down, and then a bull bar up, another bear bar down, and going up again. And this bull bar closing on or near its high. A reasonable buy, an IOI as well. Outside bar, which means this is an inside bar compared to this bar, and then another inside bar, IOI, inside, outside, inside. A reasonable buy setup at the bottom of possibly a trading range, possibly the low of the day. We have a parabolic wedge. We have a tight bull channel with 3 pushes up, 1 pullback, 2 pullback, 3, and a bear bar closing below its midpoint. Possible failed breakout here. We have big up, big down, and now big up again. A lot of confusion usually means a trading range. Double top, lower high, bear flag. We're starting to reverse down, and we're pulling back to a double top. Might break below the neckline and fall for a measured move. Wedge bear flag. We rallied on this bar. It's only a doji, but it did go down and up. And then we went down again to a new low, and we rallied a second time, and now a third time, and we're failing at the moving average with the bear bar closing on this low, about a 50% pullback of this sell-off, a reasonable wedge bear flag. We have a double bottom and a breakout. Whenever there's a double bottom and a breakout, you have 3 pushes down. We went down, we went up, we went down, we went up. We're going down, traders will look for it to reverse up. I know it doesn't look like a wedge, but it functions like a wedge, and computers will trade it like a wedge. Consecutive strong bull bars closing on or near their highs after a wedge bottom, and then a higher low after the wedge bottom. Reasonable to buy, betting that the day might become a trend day, even though we're in a tight trading range here. Lots of reversals, lots of sideways bars. Most important rule, be prepared for anything and do not be surprised by anything. The open often has big moves that immediately reverse. They might seem too big and irrational for beginners to trade, but you have to remember what the market is doing. It's trying to find out what it should do. Should it trend up? Should it trend down? It often has to test up or down, sometimes once or twice, sometimes 3 times, before traders become confident of the direction. Very common to see a double bottom and a double top on the open, and then the market decides whether to have a trend up or a trend down. As a trader, you're not really going to care if the market is going up or down. You buy because you might be buying the low of the day, and the market could rally a long way, going above all resistance. And the opposite is true near the top. They'll sell, taking a chance that this is going to be the high of the day. It was not. Here's another opportunity to sell, betting that we've begun a swing down. And if it does trend, it could fall below all support and go a long way. Sometimes you have to take multiple entries as a swing trader before you get a good swing. This went up probably far enough for a small swing trade. And then from this reversal down, it swung down for about 30 bars. If this was a 5-minute chart, that would represent over 2 hours of selling. It's really important never to have an opinion about what the market should do or what it cannot do, because on the open, you often will see very strong legs up that immediately reverse. In fact, anytime on the open you see a very strong move up or down, you have to assume that there's a 50% chance it's going to reverse. And that is true. That is absolutely true. You simply have to trade what's in front of you and do not worry about understanding why it's doing it. Don't turn on the news to find out why the market's going up or why the market's going down. It's simply deciding on the direction of the day or the direction of the next couple of hours. And a lot of times the initial direction is wrong. And then the next direction is wrong. And the next direction is wrong. Sometimes it takes a while for it to decide on the direction of the first swing. And on some days, it never really has much of a swing at all. Why trade the open? Because it has the highest probability of having a swing trade, the highest probability of making money. I talked a little bit about common patterns that traders see. About 10% of the time, the day will have a trend from the open bull trend or a trend from the open bear trend. And then the day often has some kind of a trading range early in the day. That often sets up a breakout mode pattern where there is a reversal up from a new low, reversal down from a new high. Either can occur first, and then traders look for a breakout of that opening range. And then traders also look for double bottoms, double tops, wedge bottoms, and wedge tops on the open. For most traders, they should be entering with stop orders all the time. As you gain experience, you can enter with market orders and limit orders. Most important rule is you have to be prepared for anything. 50% of the time, any strong move up or down on the open will reverse. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 6 videos on trading the open. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 6 videos on trading the open. Context means all the bars to the left, and they affect how you trade because they predict what the bars to the right will look like. Finally, I want to talk about how yesterday ended because it affects how today will trade, especially during the first couple of hours. On the open, context is slightly less important than it is during other times during the day. For example, at this point during the day, tight trading range, probably going to be a lot of tight trading range for the remainder of the day. On the open, things that appear to be low probability are much higher probability than what you think, and things that you think are high probability are lower probability than what you think. Whenever there's a reversal, even on the open, it always takes place at support or resistance. And that means on the open, the support or resistance is created by prior days, bars to the left. And therefore, it's usually good to pay attention to where that support and resistance is, because you want to see how the market will respond near that support or resistance. Do you have to do that? No, I don't need to know what the left looks like. I just know that we're far below the average price and we're reversing up on the open. The market's trying to put in an early low of the day. We're right at the average price, but below it, and the market's reversing down for a second time. It's trying to put in an early high of the day. I don't need to know what the bars to the left look like. I know that from simply looking at what I see right here. And therefore, I can trade it based upon what I see here. I think this series of slides is particularly important for traders. This is a daily chart. Here's a 5-minute chart. A white bar is a bull bar. White bar is a bull bar. On this chart, a black bar is a bear bar. And on this chart, daily chart, I have the bear bars represented by big blue bars. This is the start of today, and this is today. This is a daily chart, and this is what the day looked like on the 5-minute chart. I think it's very helpful when you're trading the 5-minute chart to look at the daily chart and see what the market has done over the prior days. Closing near the open, closing near the open, closing near the open, closing near the open. It went down, next day it went up, it went up, next day it went down, it went down, next day it went up, it went up, next day went down at least some. The market is reversing repeatedly. A day like this, the market sold off and it rallied. It reversed in one day. Here, it reversed in 2 days, down one day, up the next day. When you see this tight trading range behavior where the market is reversing every day, forming doji days, or every 2 days forming 2-bar reversals, what do you think today's going to be like? When the market's in a tight trading range on the daily chart, most of the days are 1-day trading ranges, dojis, or 2-day trading ranges, up one day, down the next. What do you think today will be like? Well, it's probably going to be a trading range day. And that means that even if you get a strong move down, it's probably going to reverse up. If you get a strong move up, it's probably going to reverse down, and the market will try to close somewhere around the open. And that means that if the market is far above the open, what do you think is going to happen? Well, it's probably going to reverse and get back down and test the open at some point later in the day. And therefore, if you see a strong rally far above the open and you see a reversal, you'll be much more inclined to sell the reversal, expecting the market to come down and test the open. And at the open, you'll look for a bounce up, maybe trying to get back to the high. So we got 2 legs down, 1 pull by 2. Bulls will look to buy a reversal up from around the open. And when the market's far above the open, even if it's following a strong rally, traders will look to sell a reversal down to the open. We're trying to reverse up to the high. Still plenty of time left in the day. Traders will still bet the day will close near the open, and therefore they'll be more willing to sell a reversal down even after a relatively strong rally. They look to the left and they see most of the days closing near the open. Well, this is what the days do. When they rally strongly, they reverse down. When they sell off, they bounce up, and the day ends up closing near the open. Look at this day. A very big bear day, closing below its midpoint and closing below the low of all of these bars. But look at here. It's a tight trading range. And you know most breakouts below a tight trading range, most breakouts above a tight trading range will fail. Therefore, if you see a big bear bar here today, what do you think tomorrow is going to do? Well, every bar to the left has either been a one-day reversal or a two-day reversal. And therefore, if you see a big bear breakout, you're going to assume it's going to be part of a two-day reversal, and that means tomorrow is going to be a bull day. And therefore, when you see this close tomorrow, you have to assume we're going to get an early low of the day, and the day will try to be a bull day, reversing this day. Can you see the difference between this chart and the last chart where all the bars were dojis? What do you see here? This is a daily chart. This bar is here. On this day, you look to the left and you say, oh, I see 4 bull bars closing above their midpoints, and several of them are closing near their highs. Therefore, what do I think today will do? Well, I think it's probably going to do what it's been doing over the past several days. And that means that it's probably going to close near its high, which means toward the end of the day, it's going to be near the high of the day. And that means it's probably going to put in an early low of the day. And therefore, I'm going to be looking to buy an early sell-off, betting that it will fail and the market will trend up and be a bull trend day like all the prior days. And then if it sells off late in the day, it's probably going to rally and close near the high. Remember I talked in an earlier video that when you have a bull day like this and a tail on the bottom, the tail is usually caused by an opening reversal down, an early sell-off that reverses up. When you have a bunch of bull days, most bars on the daily chart, even if they're bull days, have tails below. When you have bull bars with tails below, 90% of the time, that tail comes from an early sell-off. And therefore, when this day opens and you see an early sell-off, guess what? You have to assume it's going to fail and reverse up. So you have to pay much more attention to buying opportunities when you see an early sell-off like this, when the daily chart looks like this. This tail on the bottom of this bar means that the low of the day is below the open and the market reversed up from there. And therefore, if you see an early sell-off, be prepared to buy a reversal up or a pullback from that reversal up. So bull trend, a two-legged pullback to a high 2 bull flag, another opportunity to buy. Micro double bottom, bull bar closing on its high. Good bet that we're going higher. The bulls want an early test of the bears. They want to make sure that the bears are not strong. So the bulls are happy to have a strong sell-off, and then they try to reverse it up. And if they see that they are able to reverse it up, they're going to bet that the bears don't want to sell at this price. Here the bears tried again, they tried again, and each time the bulls overcame the bears. Eventually the bears give up and the bulls can get a swing up. So the bulls are happy to have an early sell-off because they want to see if they can reverse it up. And if they can, then they become confident that we're putting in an early low of the day and that we might get a swing up that could last several hours. Bulls will even buy a strong bear close like this because they look at the prior days and they say, oh, every day has a tail below. That means there was a sell-off on the open and the sell-off reversed. Therefore, if I see a strong sell-off on the open, I'm going to buy it, betting on a reversal instead of a bear trend. Stop entry bulls like to buy above bars with stops, especially a second entry buy. The market went above this doji bar, but 2 big bear bars, maybe it'll get a small second leg down. However, a second entry buy with a bull body, bulls will take that buy. Look at this. This is today, right here. This is the daily chart. And what do you see to the left? Well, over the past 8 or 10 bars, no bull bodies. Well, is today going to have a bull body? Is today going to close above its open? It might, but it probably will not. Traders are going to assume that it'll sell off early in the day, like most of the days did to the left. You know that if today is going to be a bear trend day, that tail on top probably came in the first hour or so of the day. There was a rally and it failed. And therefore, when today opens, you have to be looking for an early high of the day, a reversal down, especially a second entry. Below the bear bar here is the first entry, and then we have a second entry here, a micro double top, bear bar closing on its low, a reasonable sell, taking a chance that today will be a bear day like most of the prior days. Traders will look to sell an early reversal down. This tail on the top of this bear bar was caused by this rally. Here's the open of the bear bar. There's the high of the day. The high formed early, and this brown box represents this tail on the top of that bear bar. The bears want an early rally because they want to see if they can overwhelm the bulls and make them give up. And if they can, they'll bet that we'll have a swing down that could last 2 or 3 hours, maybe all day. And the bears will sell a reversal down, especially a second entry short, entering with a stop. And they'll also sell the breakout above the high of a bar, betting that the rally will not get very far. Here we have a bull bar, but a big tail on top. And the next bar is a big doji, a bad buy signal bar. Tight trading range, probably sellers above. Since most of the days have bear bodies, today's probably going to have a bear body. Therefore, not only are there sellers above betting that the tight trading range will continue, there are bears betting that this instead will be the high of the day, not just the high of a tight trading range. Any higher time frame can be important. Here's a 60-minute chart, and here's a 5-minute chart. When you have a higher time frame chart, like a 60-minute chart, you have resistance, but look how long it's been since it tested the resistance. 2 bars, 2 hours. Here, 3 hours since it tested that resistance. And therefore, resistance on a 60-minute chart does not give a lot of signals on a 5-minute chart. This blue line is this blue line. This is a 20-bar exponential moving average on the 60-minute chart, and I wrote a formula to show it on the 5-minute chart. This high is that high, and this high is that high. These two peaks on the 5-minute chart represent this high and then a high that occurred later over here. The formula that I use is not perfect because it's based upon the 5-minute chart. You can see that this high on the 5-minute chart did not get above the 60-minute moving average, but on the 60-minute chart it did, but it's a pretty good approximation. This is today's open. We're below the 60-minute moving average. Look at all of the bear bars here. We're below the 60-minute moving average. The 60-minute moving average was resistance here, which is right here. It might be resistance again today on the 5-minute chart. And therefore, even with a very strong rally like this on the open, you have to be prepared for the market possibly reversing down from the 60-minute chart. Remember that on the open, no matter how strong a rally or sell-off is, there's a 50% chance it's going to reverse. Here, it was simply a test of resistance at the 60-minute moving average. We have a double top at the 60-minute moving average, a double top at the 60-minute moving average. Reasonable to look for a reversal down. Second entry sell, here's the first below this bear bar, and then the second's below that bull bar, or below a bear bar here. The end of yesterday affects the beginning of today. Very strong bull trend, strong bull trend, strong bull trend. This line is the end of yesterday. This is the start of today. This is the end of yesterday. This is the start of today, small gap up. This represents the open today, small gap up. Whenever there's a strong bull trend yesterday, I call that a buy climax. It's a very tight bull channel. There's a 50% chance that the market will try to rally in the first 2 hours. In other words, follow through buying. There's a 75% chance that the market will have at least 2 hours of sideways to down trading that starts by the end of the second hour. Here it started on the open. And there's a 25% chance that there will be an early reversal. Here's yesterday, ended with climactic selling. This is the start of today, small gap down. Yesterday, climactic selling right to the close. This is the start of today. Yesterday, strong selling, climactic, down, down, and this is today, gap up. Whenever you have strong selling yesterday, climactic selling, there's a 50% chance that you'll get follow-through selling on the open. When I say on the open, it doesn't have to be the first bar, but within the first 2 hours. There's a 75% chance that even with strong selling like this, the market is going to trade sideways to up for at least a couple hours, starting by the end of the second hour. This trading range began yesterday, at the end of yesterday, and it continued on today's open. Finally, there's a 25% chance of a reversal. Strong sell-off yesterday, and then strong rally today. We have a strong buy climax yesterday, strong bull trend yesterday. Yet on the open today, we have a reversal down, and it's a micro double top. We went down on the first bar, up and down on the second bar. Traders will sell below the low of the first bar or below the low of the second bar, hoping that it's the start of a bear trend day, a trend from the open bear trend. If a trader sold below the low of that first bar, he might have put a stop to exit the trade above the high of that first bar, and if he did, he would have been stopped out. But then he could sell again on the close of the second bar or below the first bar again. Some traders would not exit their short above the high of that bear bar because think about it. Is that bear bar a good buy signal bar? Are a lot of bulls going to buy above the high of that bear bar? Probably not, because we have a very big gap up. Usually when you have a big gap up, the market does not go straight up. And usually it will not go straight up if the first bar is a big bear bar. So some of the bears who sold below that first bar will use a wider stop. If ever you sell and you get stopped out, and then the market starts to go your way again, you can always sell again. Big gap up, big bear bar closing on its low, possible trend from the open bear trend. Traders will look for an early high of the day, possibly a reversal down, a good swing short. Big gap up here, big gap up here. First bar, big bear bar, and then several bear bars. First bar, bull bar, and then another bull bar. Consecutive bull bars, always in long. When you see consecutive bear bars on a big gap up or a big gap down, the day is probably not going to be a bull trend day. It'll probably either be a trading range or a bear trend day. Likewise, when you see a pair of big bull bars on the open, whether it's a gap up or a gap down, the day is probably not going to be a bear trend day. It's probably going to be a trading range day or a bull trend day. Consecutive big bull bars, traders would buy on the close of the follow-through bar. They'll buy the close of the first bar, and they'll buy below that second bull bar, betting that it's a terrible sell setup, and therefore probably buyers below. Big gap up, bear bars became a trend from the open bear trend. Big gap up, sideways to the moving average, and then the bulls came back. We have consecutive bull bars, and then we had 2, 3, 4 consecutive bear bars closing on their lows. Some bulls would buy that close, confident that the reversal down would lead to a trading range and not a bear trend. However, early on we had 2 dojis, especially one with a bear bar. A lot of bulls don't want to buy that far above the average price. Here's the moving average, hard to see. They'd rather buy the pullback. It's okay to take that buy, but if you do, you have to decide what to do after you get a bear bar or consecutive bear bars. The bulls who bought, some would hold to use a wide stop and scale in lower, especially around the moving average, look for a reversal up around the moving average. Others would get out on the strong close of that bear bar or on the close of the follow-through bar, betting that we're going to go sideways to down to the moving average, or that we might be forming a bear trend day. Once you get the second strong bear bar, you got to be thinking that the day might be a bear trend day or a trading range day. At this point, when you had the two bull bars, you were thinking the day was either going to be a trading range day or a bull day. Once you get the two bear bars, you got to be thinking that it may be a trading range day or a bear day, and it's usually better to get out of your longs and reasonable to get short. When you have a big gap up, I'll talk about this later, you often get a sell-off to the moving average, and it can be strong. It often forms a double bottom like this at or around the moving average, or it'll have three reversals up, 1, 2, 3. Therefore, it's a wedge bull flag testing the moving average. So a double bottom testing the moving average or a wedge bull flag testing the moving average. Either one, traders will look to buy the reversal up, looking for a trend up from the moving average. We have a wedge bottom, a breakout, and now we have a double bottom with the bottom of the wedge. Again, around the moving average, bulls will buy that as well. Another reversal up, so another double bottom. Here we have a wedge bottom, a bull breakout, not particularly strong. Stronger bull breakout here, testing to a double bottom, slightly higher low, good for the bulls. Again, around the moving average. They'll buy betting that the market is possibly in a broad bull channel. Here, it broke into a strong bull trend at the end of the day. Another buy opportunity, you wait for 3 or 4 consecutive bull bars and take a chance that it's becoming a buy the close bull trend, which could go a long way. All right, what do you see? You see a rally, you see a sell-off. Is this the start of a bull trend, or is it a bull leg in a trading range? Is this the start of a bear trend, or is it a bear leg in a trading range? This is the start of the day here. Here's the start of the day here. 90% of all days have a swing trade that begins within the first 90 minutes. When you do get what appears to be the start of a swing trade, about half the time it fails and you get an opposite swing trade. And therefore, whenever I see the market rallying, I'm wondering, is it a bull trend or is it a bull leg in what will become a trading range? Whenever I see it selling off on the open, I'm wondering, is it the start of a bear trend or is it a bear leg in what will become a trading range? If a trading range is likely, you have to assume the market will go 2 to 3 hours one way and then 2 to 3 hours the other way, and then maybe reverse again in the end of the day. What do you see here? Really good looking bull bar, but look at the follow through. 3, 4 bear bars, bad follow through. A pair of good bull bars here, not particularly big, but closing near their highs, and then a very big bear bar. A pair of bull bars here, breaking out above the high of the day, but look at the follow through. Another pair of bull bars, but look at the follow through. Whenever you see really good looking bull bars with bad follow through, the rally is more likely a bull leg in what will become a trading range. It's a bull trend right now, but this bull trend probably is going to be a bull leg in what will be a trading range. Trading range behavior on the way down, but it became a tight bear channel. Eventually, the bulls gave up and we got a measured move down. Bull leg in a trading range, bear leg in a trading range. Bull leg in a trading range might have also been a bull leg in a bull trend. Bear leg in a trading range might also be a bear leg in a bear trend, but through here it was more likely a bear leg in a trading range. Lots of dojis, lots of sideways bars, around a 50% pullback, testing support, testing support, testing support. And then you got 3 or 4 consecutive bear bars closing on their lows. We're in a breakout, so probably a bear breakout below a bear channel, a bull flag, and we got the measured move down. 3 consecutive bear bars on the open, decent sized bodies, 2 particularly big bear bars closing on their lows. Very tight bear channel here, not a wedge shape. This is probably either the start of a bear trend or of a trading range. The market's clearly always in short, and it's reasonable to be short, hoping that this is the high of the day and that we're getting a swing down. Traders will sell below the first bar, they'll sell the second close, they'll sell the third close, they'll sell reversals up, taking a chance that today will be a big bear trend day. 3 consecutive bear bars and then a pause. 4 consecutive bear bars and then a pause. More consecutive trend bars than what we have here. Whenever you have a strong sell-off on the open lasting an hour or two, the market often goes sideways for several hours, and then at the end of the day, the bulls hope for a major trend reversal up, and the bears want trend resumption down. There's usually a buy signal, for example, a lower low major trend reversal here, a double bottom here, and there's also always a double top. The bears have a sell signal, the double top, looking for trend resumption down, and the bulls always have some kind of a major trend reversal, looking for trend reversal up. When the trend before is a strong bear trend, even though the probability gets close to 50-50, the more bars that you get added, there's still a slightly higher probability of trend resumption down than trend reversal up. Strong bear trend, sideways to up for about 10 bars, breaking above the bear channel. Therefore, you have to be thinking the next leg down might be the final leg, and the bulls might get a major trend reversal. However, this sell-off is in a very tight channel, and therefore the reversal up is more likely to be minor, which means a trading range more likely than a bull trend. The bulls tried again to get a double bottom, slightly higher low major trend reversal, but again, very tight bear channel. Odds are any reversal up is minor, and the market will either stay sideways or the bear trend will resume. Context is important. I'm always paying attention to what the bars to the left look like. I also pay attention to the daily chart. If most of the days are bull days, today's probably going to be a bull day. If most of the days over the past week or two are bear days, today will probably be a bear day. And that means that it'll probably get an early sell-off. If most of the days are doji bars and the market's in a tight trading range on the daily chart, chances are today will be a doji day as well, which means it'll go one way and then reverse and go the other way and try to close near the open. And therefore, in the middle of the day, if it's far from the open, I'm going to look for a reversal, betting that the market's going to get back to the open. I always pay attention to how yesterday ended. If yesterday was a strong trend day, 50% chance there'll be an attempt at a continuation of that trend in the first 2 hours today. 75% chance that today will be sideways or go in the opposite direction for a couple of hours, starting by the end of the second hour. Only 25% chance today would be an opposite trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 6 videos on trading the open. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 6 videos on trading the open. I want to talk about 2 particular breakout mode patterns that are fairly common. First, I'm going to be talking about a pattern that I call breakout mode. With that, what I mean is after the first bar, there's a new high that reverses down and a new low below the first bar that reverses up. Either one can come first. Traders then look for a breakout either above the high or the low, and they expect the breakout to last for about a measured move. And next, I want to talk about the breakout of the first 18 bars of the day. At the end of 18 bars, there's a 90% chance that the day has seen either the high or low of the day, and a lot of traders will enter a breakout of the first 18 bars of the day. We have a rally here on the open and then a trading range, and anytime you have a trading range, the market's in breakout mode. Here's a sell-off and then a trading range. However, I'm not talking about this kind of a pattern today. I'm talking about a breakout pattern that begins immediately on the open, not after an initial rally or an initial sell-off. You can look at the videos on trading breakouts to see how to trade trading ranges in this kind of a circumstance. There are 2 patterns here that I want to discuss. This first one I call breakout mode, the one on the left. After the first 10 bars, I want to see a move above the high of the first bar and then a reversal down, a move below the low of the first bar, and then a reversal up. Either can come first. Traders then look to buy on a stop above the high or sell on a stop below the low. If they take the sell, they put their protective stop above the high. If they take the buy, their initial protective stop is below the low. If the pattern occurs with fewer than 10 bars, it's less reliable. And if the opening range is more than half of the size of an average day's range, the breakout is probably not going to lead to a measured move. It'll probably simply be a trading range day. So you want the initial range to be about half the size of an average recent day or less. Today the bulls got a bull breakout above the reversal down, and therefore the odds were that this would remain the low of the day, and that means that the day would either be a bull trend day or a trading range day. The initial goal for the bulls is about a measured move up, and sometimes it can be much more, sometimes less, but that's a reasonable initial goal. Remember, you're buying the breakout because this initial range is about half or less the size of an average day's range, and you'd expect the range to get up to an average day's range, and therefore a measured move up. This black bar, the bear bar here, is the 18th bar of the day. This is the low of the first 18 bars, and this is the high of the first 18 bars, this bull bar before the bear bar. Some traders will also look to enter on a breakout of the 18 bar range. Therefore, this particular breakout mode pattern, after its breakout, also became a breakout of the 18 bar range, which is the second pattern I'm going to talk about today. I look for the 18th bar of the day. Here it's a little bull doji. At the close of that 18th bar, there's a 90% chance that the market has either seen the high for the day or the low for the day, and therefore traders look to trade a breakout of the range. If the 18th bar has a breakout a few bars later that immediately reverses, then you have to be thinking that the market may break below the opposite side of the range, and then this would remain the high of the day. Here you have a breakout of the 18 bar range and a second failed breakout of this initial range, a reasonable sell, looking for a swing down. Alternatively, traders can sell with a stop on the break below the range. Small range, reversal down from around an hour and a half into the day. Traders will look to sell a breakout below the range and expect about a measured move down. Here, the market fell for more than that. Once the bears got their breakout, they knew there was a 90% chance this would remain the high of the day, and that means that the day would either continue as a trading range day or become a bear trend day. Now, what about breaking above the 18 bar range here? Does that mean this had a 90% chance of being the low of the day? Well, at that instant, when the market here went above the 18 bar range, it did have a 90% chance of remaining the low of the day, this bar. But when it immediately reversed, that 90% quickly became more like 50-50. And then once the bears got the bear breakout, this had a 90% chance of remaining the high of the day. Is this a breakout mode pattern? After the first bar, we reversed up and we reversed down? No. So this is not one of these patterns because the reversal up did not come from below the low of the first bar. The reversal up here came from below the low. The reversal down came from above the high of the first bar. So technically this is not the same as this, whereas this is both a breakout mode pattern and a breakout of an 18 bar range pattern. I'm going to be talking about these two common types of breakouts on the open today. We have an opening range, a bear breakout, and about a measured move down. Here we have an opening range and a bull breakout and about a measured move up. I said that traders want to see the reversal down come from above the high of the first bar. Well, for me, if the trading range begins on the fourth bar, the first, second, third, or fourth bar, then I look for a breakout of that trading range. And therefore, while this is not a classic textbook breakout mode pattern that I just described a moment ago, the trading range began on the fourth bar, so I would still treat it like a breakout mode bar. After a reversal down and a reversal up, traders will look to sell a breakout below or a breakout above. Some traders sold below this bar, others sold below this bar. This is the 18th bar of the day, this little bear doji bar. At this point, traders are looking to sell either a breakout below the low of the day or buy a breakout above the high of the day, looking for a measured move. This is also a breakout mode pattern as well. After the first bar, we had a new low that reversed up and a new high that reversed down. Not enough bars, not 10 bars. At this point, we have a double top and a reversal down. At this point, there is 10 bars. Therefore, we have what we need. We have a reversal up from below the low of the first bar, a reversal down from above the high of the first bar. The range of the opening range is about half the size of an average recent range, and we have at least 10 bars in the pattern. This is a good breakout mode pattern. This is an atypical pattern. Traders can either sell below this bar or below that bar, and as I said, the trading range began on the fourth bar instead of the first bar. This is much less common than this type of a pattern. After the first bar, the market made a new high, reversed down, made a new low, reversed up. The reversal here came after about 10 bars. This is a classic textbook type of breakout mode pattern. Breakout of the opening range, closed above the high. Some traders will buy on a stop one tick above that high, or they'll buy the close, or they'll buy the close of the follow-through bar and put a protective stop down here. Their initial goal is about a measured move up, which they got. A lot of traders will front run the pattern. By front run the pattern, I mean they expect the breakout to occur and they don't wait for the breakout, they enter early. For example, after you've had the reversal down, traders are going to look for a reversal up, especially below yesterday's low, and this is a micro double bottom. This doji bar, it went down and up, we went down on the bear bar, and now we're going up again. Some traders will buy on a stop above here, expecting a breakout of the opening range and a rally for about a measured move up. Other traders would wait for this. We have the strong reversal up, and now we have a triangle. It's an III. This bar is inside that bar, and this bar is inside that bar, and you have a bull bar closing on its high. Some traders will buy on a stop above this bull bar, knowing that if it gets above that bar, the odds are 60 or 70% that it will go above the high of the day and trigger the breakout mode entry. Breakout mode, we have an early trading range. The market went below the first bar, reversed up, went above the first bar, reversed down. The range is about half or less the size of a recent range. There are only, about 7 bars in the range. That reduces the probability that breaking below the range or breaking above the range will lead to a measured move. The market usually has to go sideways more. Once you've had the two reversals, here we have the reversal down, there's a 50% chance you'll get a successful breakout above the high, 50% chance you'll get a successful breakout below the low. And that's why I call it breakout mode, because that's what breakout mode means. Equal probability of a breakout up or down. Traders can sell below the low, even though the pattern is small. They might wait for a second reversal up after the market has had about 10 bars, and then sell below this low. You can see a lot of traders sold as it was going down below that low. Strong sell-off, breakout to new low. Some traders will look to sell about a 50% pullback or on a reversal down from resistance. 50% pullback is resistance, and then testing this high. We have a reversal up here, and then the market sold off. Some bears will sell a reversal down from there, especially since this is a micro double top. We went down, up, and then down again with a good sell signal bar here. Therefore, there's a double top, and the second top has a micro double top and about a 50% pullback from the breakout below the breakout mode pattern. Reasonable to take that sell. Sometimes when you get a breakout like this and you get a reversal up, the market can become always in long, and it probably was here. We had 4 consecutive bull bars, 8 bars or so without a bear body. It probably was always in long. However, traders expect a resumption of the bear trend and they're looking to sell. Bear breakout, especially once we've had this bear breakout, 90% chance this will remain the high of the day, and that means that the day will either be a trading range day or a bear trend day, 90% certain. When the range is small like this, in terms of the number of bars, here it's only 7 bars. We've had a reversal down and a reversal up in 7 or 8 bars. A lot of times traders think that the range has to grow. They're not eager to sell below the low, especially since this is a double bottom bull flag. We have a gap up and a rally and a pullback to the moving average. Slightly lower low, but it's a double bottom bull flag. This is a reasonable buy setup looking for a swing up, and it began as a good swing up. We started to sell off, so we have a reversal down, 2 reversals down from above yesterday's high, here and again here. That is reason enough to take this sell. But anyway, after the first bar, new high reverses down, and then after about 10 bars, we have a reversal up. This is a more reliable breakout mode pattern. Also, the range is still about half of an average recent range. You can see yesterday, you cannot see the bars to the left, but this is about half of the average recent range. And therefore, it's a good stop entry sell looking for a swing down. You can either sell on a stop below the range, you can wait for the breakout bar and sell the close if it looks good. You can sell the close of the follow through bar, or you can wait for a pullback, maybe to the moving average, and then sell a breakout below the bear flag. After the first bar, we went to a new low. This low is below the low of the first bar. We went to a new high above the first bar. We reversed up, we reversed down, but the pattern is only 4 bars. A lot of traders will not consider that a good enough breakout mode pattern, and therefore they're not going to buy on a stop above the high, and they're not going to sell on a stop below the low unless the pattern first gets bigger. And it did here. New low reversed up, new high reversed down, but too small, and now it reversed down here, and it's more like 10 bars. I think it's 9 bars, but that's still a higher probability sell below here and a higher probability buy above here after we get that reversal down. Would I buy up here on a stop? I would not. It's a tight trading range, and it's a continuation of yesterday's tight trading range. You're buying near the top of the tight trading range, and the close of the breakout bar could not even close above the high of the range. This is more of a limit order market. Traders are more likely to bet against the breakout. In other words, sell at that high and sell more lower than buying at the high, betting on a measured move up. Now we've had 10 bars, close to 10 bars. Traders are more willing to sell on a stop, but it's still selling at the bottom of a tight trading range, and a lot of traders would rather sell a pullback instead of the breakout. For example, micro double top here, they might sell below that bear bar. They might sell with a limit order at the moving average. They might sell above this bear bar, arguing it's a bad bull flag after this reversal up. We have a bear breakout, closed below the low of the opening range, good for the bears, and the follow-through bar had a bear body. And that is the minimum follow-through that the bears need to believe the market is going lower. And therefore, some bears will sell the close of the follow-through bar, looking for about a measured move down based upon the height of the opening range. And you can see the day's low is just about exactly a measured move down. After the first bar, we got a new low and reversed up. We have a new high, reversed down. Too small. The pattern is only 3 bars. Traders will wait for another reversal, and therefore they'll only look at this as a reversal down, and they will ignore the reversal up. Reversal down, reversal up. So now breakout mode. And the bulls got the breakout. But, as I said several times, that does not mean bull trend. It means either bull trend or trading range. The chance of a bear trend is small at that point. Therefore, bulls either buy the breakout or they buy pullbacks. Here we have a triangle, reversal up, reversal up, reversal up. Here we have about a 50% pullback from the initial rally. They'll buy the reversal up, betting that either the day will be a bull trend or a trading range. This day remained mostly a trading range. New low after the first bar, reversed up, new high, reversed down, and we have about 10 bars, and the breakout's coming after about 10 bars. Reasonable to buy the high. The range is about half of an average day's range. Before the breakout, the bears see a new low reversing up, a new high reversing down. Some bears will sell this. It's reasonable. You have a double top below the moving average, so a double top bear flag, possible high of the day. However, most of those bears will get out above this bull bar. We have a reversal up. Second failed breakout below yesterday's low. Reversed up again, so that's good for the bulls. And the bears taking this short need the market to go down. They know the bulls will buy a reversal up. And the bulls did get another reversal up here. This is a reasonable swing buy. The bears who sold here, most of them would get out here. And that's why this bar looks like this. The bears bought back their shorts, and the bulls bought a higher low reversal. So it's a double bottom, higher low, major trend reversal after a second reversal up from below yesterday's low. Breakout mode traders will simply buy on a stop above the high of the opening range, looking for a measured move up. And they got about a measured move up, a little bit more. This is fairly common for swing traders to take multiple entries. Some bulls would have bought above this bear bar or above this bull bar for a second failed breakout below yesterday's low. The bears would then sell here, bulls will buy here. A lot of times on the open, when you're looking for a swing, you end up taking one or two entries in both directions before you ultimately get the swing. And you get some small losers, some small winners on the initial entries, and then you finally get a swing. After the first bar, we got a new low reversed up, new high reversed down. That's the minimum needed for the market to get an early trading range. In general, you want the trading range to be reasonably long. 10 bars is the reasonable guide. Sometimes it's only 4 or 5 bars. And you also want the range to be at least 30% of the height of an average daily range, but not more than 50%. If this opening range is more than half of an average day's range, and then you get a breakout, the day is probably going to remain in a trading range and not go for a measured move. Opening range and breakout mode, bulls will buy on a stop above, bears will sell on a stop below. The bears got their breakout. Other traders will sell on a stop below the pullback after the breakout. Here it's a double top bear flag. It's also a lower high major trend reversal. Bull trend, strong bear breakout, couple legs up, 1, pullback 2, and a second entry short, 1 and then 2, and a double top lower high. Reasonable swing short. As I said, this is a reasonable buy for the bulls. It's a 50% pullback of the rally from yesterday's close, and it's a double bottom with this low at the moving average. It's a reasonable buy. It's common for the market to become always in long, even when the market's in a swing short. That's what happened here. So a lot of the bears who sold here would get out immediately above this strong bull bar, knowing that it's a double bottom bull flag at the moving average and a possible low of the day. But if they did, they can sell again below this bear bar. Or they can sell again as the market again falls below the initial range, this pink box, or they can sell a breakout below that low. Strong breakout, probably get at least one more leg down. Traders will therefore sell a pullback. We have a bear flag at the moving average, they'll sell a reversal down. 2 legs up here, same thing, bear flag. Series of bear bars, sell closes, sell for any reason. You can see very steep moving average. This is a gap down from below yesterday's close, and now we're getting a reversal up. After the first bar, we have a new high reversal down, we have a reversal up, breakout mode, but the range is big. You do not see the bar to the left, but the range is big relative to the prior bar. Therefore, traders expect the trading range, and they'll look for breakouts to fail. They'll buy on a reversal up or a second entry buy here. Finally, when the breakout occurs late in the day like this, it's usually going to fail. When the market's sideways for the first 4 hours or so, it usually is not going to become a big trend day late in the day. and therefore traders will expect breakouts to fail and reverse. When traders think that a breakout is going to take place, a lot of times they'll front run the breakout. In other words, they'll enter before the breakout. For example, here we have a reversal up from a new low after the first bar. We have a reversal down, so the market's in breakout mode. This sell-off, as strong as it is simply a higher low pullback after this strong reversal up. A lot of traders are going to bet that this will remain the low of the day, and instead of looking to buy on a stop above the high, they'll buy a second entry buy here. Remember, this trend line tells us that this is a big gap down and therefore a bear trend, very strong bull breakout, and this is a higher low major trend reversal and a second entry buy. Traders often will take this buy and not wait to buy the breakout. The market rallied, tested that high, and reversed down. Reversed down from the 60-minute moving average. This is the 20-bar exponential moving average on the 60-minute chart. I have it drawn on the 5-minute chart. The market reversed down, reversed down, reversed down, reversed down. The bulls are going to give up, which they did here. Bears know that the bulls are giving up. They can see all the failures at the 60-minute moving average, and the bears will therefore look to sell. I want to talk a little bit more about the breakout of the 18-bar range. Here we have two reversals down from above yesterday's high and a gap up. Good sell signal bar. It's a reasonable sell, looking for a swing down. However, big gap up. Even if you do get a strong sell-off on the open, a lot of traders will look for an opening reversal, a reversal up from support, like the moving average or the low of the gap up. Therefore, they'll look to buy a reversal up from around the moving average. A good-looking bull bar, a double bottom, maybe slightly lower low, a weak sell-off, bad follow-through after bear bars, and 50% pullback of this rally. This is a reasonable buy for the low of the day. It's also bar 18. Remember I said that if the market breaks below the low of the 18-bar range, it probably will not get above the high of the day. And if it breaks above the high of the 18-bar range, that probably means the low of the day is in. It will not break below the low. Therefore, when the market gets to be around bar 18, bar 15, bar 16, 17, 18, 19, 20, and if it's near the low of the day, bulls are going to buy a reversal up, betting on a breakout above the 18-bar range. Likewise, if it's near the high of the day, around bar 18, bears will look to sell a reversal down, betting that instead of getting a breakout above the 18-bar range, the market's going to reverse down and break below the 18-bar range. Other traders will simply wait for the breakout and they'll buy with a stop above the high of the 18-bar range, or they'll buy pullbacks. Once they have this breakout, only a 10% chance the market's going to break below this low, and therefore the day is either going to be a bull trend or a trading range. In either case, if it goes sideways to down, it probably will reverse back up. Bulls will therefore buy a reversal up. This is the 18th bar of the day, and we're near the high of the day. Therefore, some traders will sell a reversal down, betting that the market will fall below the low of the day and fall for a measured move down. The market reversed up pretty strongly here, and therefore taking a sell here is a relatively low probability bet. But the risk is small as well. If a trader sells below this bar, it's a micro double top and a double top around the moving average, around a 50% pullback from yesterday's sell-off. The risk is small. You sell below the low of this bar, you get filled here, put your stop above. Small risk, and that compensates for the low probability. Around the 18th bar, if you get a reversal down and you're near the high of the day, reasonable sell, or you can wait to sell the breakout below the low of the day. The bears who take the sell on the breakout sell one tick below the low of the day, looking for about a measured move down. These bears have a higher probability of making money. However, whenever you have higher probability, your risk reward is worse. Usually your stop is further away. It's a reasonable trade-off. These bears are selling a high probability trade. These bears are selling a low probability trade, but with very good risk reward. Both are reasonable sells. Strong reversal up, 2 legs down, 1 pullback 2. Failed breakout below the day's low, but market's always in long. And then a weak sell-off to a higher low, testing the buy signal bar high here or here, a 50% pullback of this reversal. It's reasonable to buy this for a higher low major trend reversal and the low of the day. Whenever you have a reversal after a big sell-off, the market will often get up to the high of the day, sometimes above, but rarely will you get a big trend day. Whenever the initial move is very big, then you get a reversal. Usually you end up with a trading range day, a swing down and a swing up. If it goes the other way, if there's an initial rally that is about the size of an average day's range and you get a reversal down, usually you're not going to fall much below the low of the day. Most reversal days become trading range days. Here we got a big sell-off, we reversed up. If we had a big rally and reversed down, it probably would remain a trading range day as well. Big gap down, reversed up from below yesterday's low, reversed up a second time from below yesterday's low. Reasonable to buy here or here. If you did, you probably would either have lost money, or if you used a wide stop, you could have made money, especially if you could scale in lower. Anyway, at this point, we have a double top bear flag, not quite at the moving average, not a high probability short, especially after 2 good bull bars. This is, I think, low probability trading, buying above this bar, selling below that bull bar, buying above the bear doji, selling below the bear doji, low probability trading, and a lot of traders will wait for clarity. And what they have here is a third push down with a very good bull bar. So now it's a wedge bottom with a very good bull bar. It's a reasonable buy on a stop above that high. This is the 18th bar of the day, this bull bar. Therefore, the low of the 18 bar range is here, the high of the 18 bar range is here. Reasonable to take this buy. You're front running the breakout of the 18th bar, which you ultimately got. And once you get that breakout, only a 10% chance you're going to fall below the low of the day. Therefore, the day is either going to be a bull trend day or a trading range day. This turned out to be a weak bull day. Traders bought reversals up from sell-offs. After the first bar, we reversed down and reversed up, we reversed down again. It's a breakout mode pattern. Some bears might sell here. You can see the big bear bar. But when it immediately reverses up like this and you see a wedge, up, 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 most bears would get out and most bulls would buy. Even with these reversals, the first reversal down and up only is 5 bar pattern or so, and too small. Most traders will not trade that. And we have now a reversal up and a reversal down. It's a bigger pattern, but still fairly small. Most traders are not going to sell on a breakout below the low. This bull bar is the 18th bar of the day. Traders, therefore, will look to buy a breakout above the range or a pullback from the breakout, and they'll look to sell a breakout below the range or a pullback from the breakout. Some traders will front run. We have a good reversal up here from below yesterday's low, and then a bull inside bar here for a second entry buy. Reasonable to buy. Remember, if around bar 18 the market's near the low of the day and it's reversing, especially a second reversal buy, it's reasonable to take the buy, betting that instead of a breakout below the 18 bar range, we'll break above the high. 18th bar of the day with multiple reversals, and the range is relatively big relative to what we've been getting. Therefore, higher probability to bet on a trading range and failed breakouts. So instead of selling at a low of the day here, it's better to look to buy, especially if there's a micro double bottom, and there is. bear bar, we went up, we went down, and we went up again. Reasonable to buy on a stop above that bull bar or even above that bear bar. We went down, we went up, we went down more, up more, down more, up more, down more. So it's a growing, expanding triangle, and that is another reason to take this buy. It's actually a reason to take this sell, but with this strong reversal up after this strong reversal up, a lot of traders are not going to take that sell, although it's reasonable. Today I talked about two types of trading range patterns that come on the open. The first I call breakout mode. For breakout mode, I'm looking for a new high that reverses down, and then a new low below the low of the first bar that reverses up. Ideally, the second reversal occurs on the 10th bar or later, and this opening range is about half the size of an average recent day's range or less. And then next I talked about the breakout of the range of the first 18 bars. In either of these breakouts, once you get the breakout, 90% chance the market's not going to break out beyond the opposite side of the day. So for example, if you get a bull breakout, 90% chance the day will either be a bull day or a trading range day. If you get a bear breakout, 90% chance the day will either be a trading range or a bear day. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 6 videos on trading the open. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 6 videos on trading the open. I want to talk about the market breaking out above yesterday's high or below yesterday's low and then reversing. That is a very common thing, and it's a very common setup on the open that leads to a swing trade. Sometimes the market will break above yesterday's high and reverse down, but the reversal fails and the breakout resumes and the market continues higher. That's a failed reversal of a breakout of yesterday's range. And the same can happen with the bottom. It can break below yesterday's low and then reverse up, but the reversal does not get far, and then the bear trend resumes. Here are a couple charts with breakouts. The blue line is yesterday's high. The market went above yesterday's high and reversed down, but below a bull bar, most traders would not take that short. It went above yesterday's high again a second time, and it reversed down again, and this time with a bear bar closing on its low. That is a good setup for a swing short. Traders sell with a stop one tick below the low of that bear bar, looking for a swing down. A second entry of any trade has a higher probability of success. A bear bar closing on its low is a much better sell signal bar than the bull bar here. Therefore, it's a higher probability sell. A very important point is that there are many ways for these second entry trades to set up, and you have to be open to anything. What you have to be focusing in on is a reversal and then a second reversal, no matter what it looks like. And you want the second one to have a good signal bar. This blue line is yesterday's low. The market traded below it and reversed up, but a bear bar, not a good buy signal bar, even though the market rallied pretty strongly. And then it broke below yesterday's low again here and reversed up again, and this time a decent looking bull bar, a bull bar closing on its high. That is a higher probability buy, buying on a stop above that high. Again, focus on the second reversal, and there are many ways it can happen. Sometimes the bars can be 10 bars apart, sometimes just 2 or 3 bars apart. Here's another strong rally on the open that breaks above yesterday's high, and it's a second entry short. Can you see what I mean by the second entry short here? The market went below the bear bar. That's a reasonable short, but with this many bull bars, most traders would want a second entry short. And then it rallied to a new high here and then reversed down a second time. The second entry is below the low of this bull bar or below the low of that bear bar. So micro double top. It went down below this bear bar and went up to a new high and then reversed down a second time. A second entry for the sell signal, breakout above yesterday's high. A bull bar, not ideal. A lot of traders prefer to sell below a bear bar, which would be right here. And the bear's got a couple legs down. Micro double top, and therefore it's a type of low 2. The second high does not have to be above the first. Here it was. You're simply looking for a second entry, the first one failing, and then a second one forming. After the first couple of hours, the market reversed up from a wedge higher low, a gap up and a rally, and then a two-legged pullback to a wedge higher low. 3 big bear bars. A lot of traders will not take the first reversal up. They'll take the second reversal up. Yesterday's high, the market tried to reverse down from below yesterday's high, but below a bull bar. Some traders would sell below the bear bar, but with the 2 bull bars here, a lot of traders would wait. The market resumed up, a high 2, and went above the bull bar, and then above this bull bar after a gap up. Some bulls would buy that, but that big tail on the top of the buy signal bar would make a lot of traders hesitate. And then we got a bear bar here. First entry sell below a bull bar or below this big bear bar, and then this is a second entry for a failed breakout above yesterday's high. Above yesterday's high, reversed down for a failed breakout, and now we're getting a second entry failed breakout with a better looking sell signal bar. Yesterday's high, the market broke above it. It tried to reverse down here, but there was no stop entry sell. We're looking for stop entry sells. The first entry is below this bull bar. You could argue that there's a second entry below this bear bar, but with the doji and the prominent tails and the 3 bull bars here, a lot of traders would wait to see if they get a better sell signal bar, which they did here. So that would be a better sell. They put their stop above the high of the sell signal bar, and this high got exactly to that high and did not go above. Therefore, some traders would hold short, relying on their stops. Others would say, we're breaking out above yesterday's high, and this is a 2-legged pullback, 1 pullback 2, with a decent buy signal bar, and therefore some traders who sold below here would exit above here. Other traders would buy above here, hoping for the low of the day. When the market formed a double top here and turned down again below this bear bar or below this bigger bear bar, a lot of traders would sell. It's at that point a second entry sell, which is here, and then now you're getting another second entry sell here and a double top lower high. Double top lower high with good sell signal bars there and here, a reasonable short for a swing down. The traders who sold here, they could either put their stop just above the sell signal bar. It would not have been hit here. They could hold short, or they could get out above the bull bar and then sell again once we have a double top triggering with the bear bar closing on its low. So they sell below that bar and get filled here. Take a look at this. Yesterday's a very small, quiet day. Whenever yesterday's a small day like that, there's an increased chance that today will be an outside day. Either trade below yesterday's low and then above its high, or trade above its high and then below its low. And today, it did both. It traded above the high and then below yesterday's low, and then back above yesterday's high again. We went above yesterday's high and reversed down below a doji, not a very good sell signal. And then we're reversing down again, this time below a bear bar closing near its low. That's a higher probability sell. You could hold for a couple legs down. Most traders would get out above this bull bar. Other traders will hold, stop above the high of the sell signal bar, and see if the market ultimately breaks to the downside, which it did. This rally never went above the high of the sell signal bar, and therefore never hit the stop. If traders did get out down here, or for any reason, if they went long here, they're going to get out below this bear bar for a wedge, 1, 2, 3 reversals down, or below this bear bar as well, especially since it never went above the stop for that original sell. Parabolic wedge bottom, and a second entry buy for a failed breakout below yesterday's low. The market broke below yesterday's low, tried to reverse up. Doji bar, not particularly good, especially after a strong sell-off. And now the bulls get a second entry buy with a good-looking bull bar. This is a reasonable buy. You could also wait to buy the pullback, so strong reversal up and a pullback. This is a type of cup and handle bull flag right here. So we get a reversal and then a pullback, and that is by definition what a cup and handle pattern is. A cup and handle pattern is a reversal followed by a pullback, and that's a buy signal, a bull flag from this rally. The rally ultimately went back above yesterday's high, so an outside down day and an outside up day. Yesterday's low, we gapped down and we tried to reverse up above that bear bar and above this bull bar. Did not get very far. We sold off again, and now we're trying to reverse up again. I would not buy above the bear bar. I prefer to buy above a bull bar like this bar. Or you could argue it looks like a tight trading range. Wait for a better buy. And here we have a bull bar closing on its high. At this point, you can call it a triangle or a tight trading range or a third entry buy, but one with a pretty good bull bar. That's a pretty good buy. And we got a strong reversal up from there. If you do take that buy, stop is below the low of the day. Today opened up above yesterday's low and then sold off immediately and fell below yesterday's low and reversed up above a bull bar. Tail on top, fairly prominent body. It's an okay buy, but a lot of traders would rather get a better looking buy or a second entry buy. Second entry buy was above this bear bar, not great, or above this bull bar, better. So that's a higher probability buy. It's also a test of the low from 2 days ago, a perfect double bottom here, and a wedge sell-off, a wedge bear channel. Wedge bear channel, bull flag, you expect a bull breakout. And that makes all of this a higher probability buy, especially above a strong bull bar like that. You could simply buy above this bull bar. But once you see this bull bar, the probability is high that we're going to have a swing up. Pull back to the moving average and a wedge bull flag. Again, another cup and handle pattern where you have a reversal and then a pullback to a bull flag. The reversal is the cup and the bull flag is the handle. You could also call it a higher low major trend reversal, which is what most cup and handle patterns are. A wedge rally, a lower high, decent sell signal bar, okay short later in the day for a scalp. Couple of the trades, a double bottom, pullback, a bull II, reasonable buy, and then a lower high, a wedge rally, bull bars bear, bull bars bear, bull bar. So a third set of bull bars and a reversal down. Strong sell-off on the open below yesterday's low. We tried to reverse up here. It's a reversal up from below the trading range, but not from below yesterday's low. And then we sold off very strongly. Strong sell-off like this probably will get at least a second leg down. Most bulls would not buy here. However, they would think about buying here. Even though it's a huge sell-off, it's still a second entry for a failed breakout below yesterday's low. If you want, you can call it a parabolic wedge. I would not really call this a parabolic wedge. I would simply call it a sell climax and then consecutive sell climax. And then a pretty good looking bull bar, especially since there's a micro double bottom. So a reasonable buy above that high, looking for a swing up. Whenever you get a reversal day like this and the sell-off initially is very big, here the sell-off is about the size of an average day's range. It's in fact bigger than yesterday's range. Whenever you have a very big sell-off and then a reversal, usually you do not get a bull trend day. Is this a bull trend day? I would call it a trading range day. We went down, we went up, and we did not get much above the open. And that's usually what happens when you get a reversal after a very big sell-off. If the sell-off is small and you get a reversal, then you can get a big bull trend day. But if you looked at this on the daily chart, it's a doji bar. Here's the open, there's the close. And for me, it's a trading range day, even though it trended up all day, or most of the day. Big sell-off on the open when it's about the size of an average day's range. If you get a reversal, usually the market has a hard time getting much above the open, if it gets above the open at all. Market gapped below yesterday's low, tried to reverse up here. We have a micro double bottom, but a doji bar and a bull doji bar here. A lot of traders would want a second entry buy above a better bull bar, which they got here. We went down big, up big, probable trading range. We went up big and down big, confusion, probably trading range. Strong enough reversal that bulls would try to get a higher low major trend reversal. So bear trend, bull breakout, higher low. And the market simply went sideways for several hours. The bears got trend resumption at the end of the day. We broke below yesterday's low and reversed up. Good looking bull bar. Broke lower and reversed up a second time. Some bulls would buy here, or they would wait to see if they could get a better setup. And here we have a small higher low. strong reversal up from a second entry for the failed breakout below yesterday's low. And now we're getting a decent buy signal bar here. So that would be another buy. And then we have a higher low major trend reversal here. So that would be another buy above that bull bar or above that inside bar. It's pretty common in the open that you have to take several trades before you get a swing. A lot of the bears would sell below this bear inside bar. And we have a wedge bear flag at the moving average. So it's reasonable if you bought here to get out below this bear bar. And it's also reasonable to get short, looking for a bear trend. And then the bulls have a higher low major trend reversal. If you want, you can call it a double bottom. Therefore, a lot of the bears who sold here would get out here. A lot of the bulls would buy here. The day ended up mostly sideways. There was a rally at the end of the day. Another double bottom, higher low major trend reversal. This higher low major trend reversal is bad. 4 bear bars and then a bear inside bar here. Usually that's going to be a minor reversal, and traders will look for a major reversal later in the day. And here, this is better. A double bottom, slightly higher low, with 3 bull bars closing on its high, so you buy above there or above here for a swing up at the end of the day. I said that sometimes the market will break out above yesterday's high and reverse down, and then the bulls buy the reversal and the bull breakout resumes. So there's a failed reversal of the breakout of yesterday's range. And the same can happen at the bottom. You can break below yesterday's low, try to reverse up, but that reversal attempt fails and the bear breakout resumes and the day becomes a bear trend. Every pattern can fail, and you should be aware of how a failure looks. We broke above yesterday's high, reversed down, and then we had a second reversal either here or here. However, we have a pretty good rally here and a lot of bull bars here. You have to be aware that this may not lead to a bear trend. Instead, it led to a trading range. And at some point, you have to decide that the sell is going to fail. Here we have 4 bull bars. Here we have 6 bars without a bear body. It looks like the sell is failing. A lot of the bears who took that sell would get out above this bull bar here, a second entry by holding above the moving average. And then at this point, this big bull bar represents everybody deciding that the market is going higher and that the sell is going to fail. The bears who took this short are disappointed that it immediately reversed up at the moving average and immediately reversed up again a second time with a good looking bull bar. Most of these bears would get out here, and then the final bears gave up here. And the bulls are doing the opposite. They know the bears are giving up. The bulls are looking to buy to get long. This pullback stayed above that breakout point. This pullback stayed above that high. It's a small pullback bull trend day, which is a very strong trend day. A big buy climax at the end, and then profit taking into the close. Bulls would buy all of those little bull flags looking for another leg up. And at the end of the day, some bears would sell for a scalp down and the bulls would exit. This is a buy the close finish, probably starting a little bit too early, starting around noon. Normally, a buy the close finish has to start closer to 12:30 if it's going to make it to the end of the day. If it starts too early, it usually reverses. The market was above yesterday's high, tried to reverse down a second time, but then it became a bull flag. This is a high 2 bull flag, especially above this bar. At some point, these bears have to decide to give up. If they enter short below that bear bar and it immediately reverses up, they're going to be pretty quick to get out, either above this bull bar closing above its high or above that bull bar. The bulls will buy this as a high 2 bull flag. So a bull trend, the gap up is a bull trend, and then a pullback, and then a second entry buy above that bar. Ultimately, there was a wedge top and a second entry sell. First is below a bull bar, second below the bear inside bar, and the bear's got to swing down. The market gapped below yesterday's low and below the 20-bar exponential moving average on the 60-minute chart. So this is the 60-minute EMA. This is the 5-minute EMA, and I have a formula that allows me to plot the 60-minute EMA on the 5-minute chart. The market broke below yesterday's low and below the moving average and reversed up. A reasonable buy, and then a higher low, reasonable buy. But then look at this. We sold off, we're selling off at the moving average and around a 50% pullback of the sell-off. Therefore, this is a reasonable sell signal as well. So the bears will short that. Bulls will buy this, they'll buy this, and then everybody shorts this, a wedge bear flag, 50% pullback at the moving average, opening reversal down from the moving average. Strong bear breakout, immediately reversed up above a pretty good bull bar. Remember, on the open, no matter how strong a leg up or down is, 50% chance it's going to fail and reverse. If you see a strong sell-off like this and then a bull bar, especially a bull inside bar closing near its high, you have to get out of shorts and it's a reasonable buy. This is a large double bottom. We went up again, a lower low double bottom, lower low major trend reversal. It's a large second entry buy. Here's the first entry buy, failed breakout yesterday's low. Here's the second entry buy, failed breakout yesterday's low. This is a 5-minute chart, and if you looked at a 15-minute chart, it would probably be a fairly simple looking second entry buy, failed breakout below yesterday's low. The bulls take the reversal up here and here. The bears sell the reversal down below that bear bar or a second entry short here. At this point, we have a lower low major trend reversal, pretty good rally, and a higher low major trend reversal, a reasonable buy, a wedge higher low. 1, 2, and 3. Yesterday's high is important resistance. Yesterday's low is important support. If the market breaks above yesterday's high and reverses down, that's a reasonable sell, especially if you have a second entry sell. If it breaks below yesterday's low and reverses up, especially a second time, that's a reasonable buy for a swing up. However, sometimes when the market reverses up from below yesterday's low, it becomes a bear flag and the bear trend resumes. So you have to be aware that the reversal will not always work, and you have to be prepared for the bear trend to resume, and you have to get short again. And the opposite's true at the high. If the market breaks above yesterday's high and reverses down, but the reversal becomes a bull flag, you have to be prepared to get out of shorts and to look to get long. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 6 videos on trading the open.